morning everyone and welcome to my presentations. My name is Ji Feng and I'm from Group 4. My team members are EU, Brandon and Iham. As managers for this task, we will be constructing a hypothetical portfolio according to our client needs. Consequently, our client is based in Canada and we will be managing investment from the Toronto Stock Exchange. The Canadian government announced that the interest rate will be 0.25% for the year 2021. As such, our objective will be generate a higher return than risk-free asset rate of 0.25% using the capital of 100 million raised by our client. Moving on, our client holding period is subjected to 1 year, therefore our client is risk averse and is not willing to tolerate many risks in the portfolio. Hence, our client specifically wanted low risk assets at 40% to 40% risk. Furthermore, our clients wanted to diversify the portfolio by investing in multiple sectors to eliminate the unsystematic risk. Finally, our clients would want to invest in equity investment rather than trade indexes. In addition, the portfolio construction strategy we use is the market-based portfolio theory. It is a portfolio strategy that offers the highest expected return at any level of risk. Besides, the theory states that the investors are risk averse, suggesting that they consider only the speculative opportunity with extra compensations. In addition, the idea of the theory is that the portfolio's overall risk can be minimized by adding securities that are not perfectly positively correlated. According to our client preference, we have constructed a portfolio consisting of 6 sectors, which are technology, energy, transportation, healthcare, financials, and manufacturing. Hence, we have picked 28 stocks from the 126 stocks across various sectors to invest in, and the total expected risk is 9.01%. At the end of the year, we achieved a total return of 28.51%, which is slightly lower than the expected return of 29.79%.
Our sample includes 126 public companies listed on the Toronto Stock Exchange in Canada. The companies are selected across various sectors as requested from our client. Investing in different sectors allows us to minimize the firm's specific risk to accommodate our client's risk appetite. As such, there are 6 sectors included in the sample. The first sector is the technology sector. One of the reasons to selecting this sector is because the technology sector accounts for almost 50% of Canada's GDP. Consequently, the growth rate for the sector is also forecasted to increase at 22.4% annually from 2021 to 2024. This is because the need for technology is increasing as companies become more reliant on technology. Hence, this would mean that there will be massive opportunity for growth in the sector. The second selected sector is energy. Canada is known for being one of the largest energy producers in the world, with petroleum and natural gas being the main resources for the country. The energy exports contributed more than 100 billion Canadian dollars to its GDP in 2020. As such, the energy sector in Canada contributes largely towards the country's economic growth and boosts our confidence in selecting the sector as we believe there are room for growth. The third sector is the transportation sector. This sector is expected to grow at an annual growth rate of 3.5% from 2020 to 2025 due to global economic rebound. As vaccinations are available worldwide, Board Immunization Program has planned to lessen lockdown restrictions and allows the transportation sector to return to pre-pandemic level. Healthcare is the fourth selected sector. Health expenditure in Canada was estimated to around 12.7% of the country's GDP. The constant evolvement of technology has increased efficiency in the healthcare sector in today's world. As such, we selected the healthcare sector as we expect this sector to have outstanding performance in 2021. The fifth selected sector is the financials industry, which is one of Canada's most significant sectors. The sector is expected to grow modestly in 2021 and 2022, driven by increasing consumer demand, household mortgage growth, and central bank fiscal expansionary stimulus to offset the influence of COVID-19. Manufacturing will be the final sector. The performance of the manufacturing sector is expected to grow along with technological advancement. For instance, manufacturers' overall costs and production errors are reduced by increased production efficiency. Hence, we expect the manufacturing sector to be in an uptrend similar to the technology sector. After selecting potentially growing sectors, firms are filtered according to the largest market capitalization. Companies having the largest market cap are preferred as they are more reputable and transparent on business information. If a sector contains less than 20 stocks, we will be including the whole sector. I will now pass the time to Yihang to talk about our method of constructing the portfolio.
And so for the method to construct portfolio, our portfolio is constructed according to the Markowitz portfolio theory. Because our client is risk averse, by utilizing this theory, it can allow us to maximize our client's return despite setting a very minimal level of risk. We are required to have the average monthly return for each stock to calculate the expected return, the monthly standard deviation to calculate risk, as well as the weightage of capital for each stock. And for the estimation of expected return, we decided to determine the estimated return of each stock by using the holding period return method. To compute the equation, we collected each stock's 2 years historical price and dividend paid from December 31st, 2018 to December 31st, 2020. We assume that the price at the end of the month is the beginning price for the next month. We estimate the risk by using the standard deviation, as it is one of the most common mathematical concepts used to determine risk. This allows us to deduce the spread between the asset prices and their average price. Next up, for the weightage allocation, to obtain the weightage, we need the monthly covariance matrix. To get the figures of the monthly covariance matrix, we input the formula as shown in the slides to the monthly return of each stocks between January 2019 to December 2020. Next, we obtain the portfolio's monthly variance using the formula as shown in the slides. Moving on, we obtain the portfolio standard deviation using the formula as shown in the slides, where C4 is the portfolio's monthly variance. Then we input the objective and constraint into the solver, and the weightage will appear. The objective is set at the minimum to find low-risk stocks. Next, we input the first constraint as shown in the slides, which means the total weightage of all stocks is equal to 1. This constraint allows all capital of 100 million Canadian dollars to be invested in the portfolio. The second constraint as shown in the slide is set the weightage should be larger or equal to 0 to make sure there is no negative weightage allocated. As such, stocks that are assigned with a weightage will be included in our portfolio and vice versa. After the weightage allocation, there were a total of 28 stocks that were selected, and we expect our return at the end of the year would be 29.92% by expecting a 9.01% of risk on return.
On 21st December 2021, we received an annual return of 28.51%, which is 1.46% lower than the expected return. By comparing the expected price and the actual price at the end of the year, 11 stocks have been overvalued, while the remaining 17 stocks had outperformed expectations. For technology sector, the actual return on all 3 companies are lower than the expected return, yet 2 of the stocks are still in profit. According to UNCTAD, innovation of artificial intelligence, nanotechnology, and robotics had caused an abrupt increase in Toronto Technology Index from 2020 and started to decline in September 2021 when the market found that technology sector has been overvalued. Nevertheless, this momentum has successfully led to a positive returns from mission-ready solution and Poyer Technologies. However, for Gatekeeper System, the reason of having a negative return was because of its decreasing revenue from a net profit of $2 million to a net loss of $300,000 in 2021. For energy sector, all of the stocks achieved higher returns than expected, while Spartan Delta did not. In the year of 2020, declined global economy and decreased demand for industrial and commercial energy had caused a huge fall in the market price of energy-related stocks and were likely to be undervalued. Hence, high potential for greater investment return has attracted investors to invest into energy-related stocks and caused them to rise dramatically in 2021. However, Spartan Delta, which has the highest expected return, could not reach its expected price at the end of the year. This is because the expected return was too high, as its stock price in 2019 was sharply fluctuated due to minimal volume traded. For transportation sector, 3 out of 6 stocks outperformed the expectation. The remaining stocks, namely Canadian National Railway and Canadian Pacific Railway, provided positive returns except for Ace Aviation Holdings. The reason for the high return from transportation sector was because during the pandemic, the shift in consumer spending habits to online shopping has provided the transportation sector an opportunity for growth, which in turn attracts investors to invest in transportation companies. However, the reason for Ace Aviation Holdings to have negative return is because it was undergoing liquidation. For health sector, 3 out of 5 stocks had exceeded their expected returns. Biomax Diagnostic had a lower return than expected, while SQI Diagnostic had a negative return of 33.33%. The reason for SQI Diagnostic to have a negative return was because the company has been experiencing net loss for several years and resulted in investor disbelief towards the company. However, most of the healthcare-related stocks attained positive returns because investors believe that there will be room for future growth in healthcare technology companies as they are able to provide immense benefit in this period of time where diseases are constantly evolving. For financial sector, 5 out of 7 stocks had exceeded their expected return, while the remaining 2 stocks, Intech Financial and TMX Group, did not. Although Intech Financial and TMX Group had not exceeded their expected return, the stocks still had positive returns. As we can see from the graph above, the financial sector had grown at a stable pace during 2021 and did not have a big fluctuation throughout the year. Therefore, most of the stocks from the financial sector achieved a positive return and exceeded their expected return. Lastly, 3 stocks selected from the manufacturing sector had all exceeded their expected return. TerraVest Industry and Hammond Power Solutions are companies that provide products and services to companies in the energy sector. As the energy sector performs well in 2021, companies from the manufacturing sector that supply products and services to energy companies followed suit and exceeded their expected return during the holding period. Conversely, the reason for Three Island Steel to have a higher return was because it had been constantly growing in profit over the last 2 years.
Despite having returns that surpassed expected returns and it swayed favorably towards our client, it may not be the same in the upcoming year. Proper risk management should be particularly evaluated as there are many uncertainties that could occur in this fast-shifting world. We have identified 2 weaknesses and solutions on how we constructed the portfolio for our client. And next up would be the risk management. So for the weakness, no maximum risk threshold was allocated. This means that the investor may end up losing more. And the solution to this would be to implement the stop loss strategy. By setting a stop loss, allow certain stocks to only lose the amount we can risk. Now for the stock selection, we realized that we had invested into a stock which is called Ace Aviation Holding that was undergoing liquidation because we included every stock in a particular sector where the sector had less than 20 stocks. Therefore, we were unable to filter out companies that has low market capital trading volume or even poor financial performance. And the solution to this would be to filter the selected stocks according to the company's performance, market capitalization, as well as the trading volume instead of including all the company from a particular industry.
In conclusion, the computed expected return for our portfolio was 29.92%, but we were slightly underperformed as we obtained a return of 28.51%, which is still higher than the risk-free asset rate of 0.25%. However, we have re-evaluated our work and identified our weaknesses and solutions to improve in the near future. With that, our portfolio actual return has outperformed the rate of risk-free assets. We hope that our client maintains the confidence in us and continue to retain us as the fund managers moving forward.
And that will be all from Group 4. Thank you so much for listening.